Everyone keeps saying that Canadian real estate pricing is somewhat holding steady and there hasn't been large declines in price point. What if I told you that wasn't true, and when we adjust for inflation, I'm going to be proving that fact today. We know that our dollar definitely does not buy as much as it did over the last couple of years, and when we adjust Canadian real estate pricing with inflation, we're seeing levels of pricing that we haven't seen since 2017. Even though the headlines aren't saying it, inflation is costing Canadians a lot of money when it comes to property pricing. I'm going to jump in the charts here so I can show you the real data. We'll also go into the consumer price index, explaining what these buckets are, how it's calculated, and how it affects real estate. Because whether you're a buyer, seller, investor, it doesn't matter. It's really important to see what inflation is doing to real estate pricing and how you can prepare yourself with proper purchases or proper strategies for selling moving forward. So let's jump into the consumer pricing index and go over what really this is. So as you can see here on screen, and this is from StatCan, the consumer price index represents changes in prices as experienced by Canadian consumers. It measures price change by comparing through time the cost of a fixed basket of goods and services. So this goods and services basket is really important to understand because sometimes it can get manipulated. So depending on where and how they look at the data for the consumer price index, that's where Canada bases their inflation on, certain areas and certain levels have more weight than others. So the goods and services in the CPI basket are divided into 8 major components: food, shelter, household operations, furnishings and equipment, clothing and footwear, transportation, health, personal care, recreation, education and reading, and alcoholic beverages, tobacco products, and recreational cannabis. CPI data are published at various levels of geography, including Canada, the 10 provinces, Whitehorse, Yellowknife, and Iqaluit, and select cities. So this is great knowing that there's 8 components, but where this really comes into fruition is understanding how these 8 components come together. With what you're going to see on screen here, you can see the composition of the Canadian Consumer Price Index. This is a chart from 2023, but it shows the percent on which the Canadian government bases their inflation data on. And you can see that the biggest one here definitely is shelter at 28.6%, transportation 16.8%, and food a little bit underneath there at 16.7%. We have household operations, recreation, health, and all those other items we spoke to before. So when we talk about consumer pricing index and how inflation can be a little bit manipulated, because shelter is sitting at 28.6%, and this comes into effect when they consider mortgage payments and even rents. They're both in this bucket. Obviously, when the Bank of Canada can adjust its policy rate, they can adjust inflation numbers. So for example, if the Bank of Canada today wanted to drop their policy rate by 1%, for example, the overall inflation in Canada would drop like a rock because this is such a huge bucket here. So depending on what the Bank of Canada wants to do in terms of their inflationary numbers, they can manipulate the inflation because it's such a big base here on shelter. When we talk about transportation, this is vehicle costs and fuel. That's why our inflation numbers have been continuing to drop as well. Oil pricing recently has dropped as well. And because it makes up such a large component of the CPI index, that's why we've seen some of these inflationary numbers drop, despite the Bank of Canada holding their policy rate reductions for the last 2 months. So when we look at the consumer price index and understand how it works, when they take an overview of all these items from transportation to shelter to food, they can track it on an index. So every single year or whenever they want to adjust it, they can see how much was a liter of gas in 2005 compared to 2025, or how much was a loaf of bread in 2024 now here in 2025. And when they see the changes, that's how they adjust their inflation and come out with a number. They want to stay in around that 2% range. They only want items and inflation to be going up around that 2% number, but we've been well above that fact. And when inflation goes up, essentially you just need to make a lot more money to buy the same product, and it's no different for real estate. This chart here is super powerful, and I'm excited to go through this with all of you because it's really important to understand how this chart works. So this is provided by Fred, the Federal Reserve Bank of St. Louis, and the key word here is real, because in the real residential property price of Canada, it denotes this is the real price adjusted for inflation here. So these data points go all the way back to 1970, and I'm going to scroll down here a little bit so you guys understand how this chart works. So firstly, the index for 2010 equals 100. 100. That is a benchmark that we'll go over in a little bit. The coverage includes national residential average. The series is deflated using CPI, so it's adjusted on the consumer price index. And then a disclaimer here, any use of the series shall be cited as follows. Sources, national sources, BIS, residential property price database right here. So what do some of these things here mean? So in 2010, they put a baseline here of 100, and it helps us track everything moving forward. So in 2010, property pricing was at an index at 100, and when we look here, and this is something interesting that we're going to go over in a little bit as well, this most recent data is just from Q4 of 2024 with an index of 153.81. So what does that index mean? Because we have that index at 100 in 2010, property pricing has increased 53% since that marker, which really in Vancouver terms is not a lot, and it's because of this inflation. You'll see here at the maximum here in 2022, we were at 200. So a doubling up in terms of the index from 2010 all the way up to 2022. But since that time, from Q1 of 2022 to here, Q4 of 2024, we have dropped in that indexing by 47. And what's scary about this chart is that this is only taking in consideration the end of 2024. It doesn't have the first 2 quarters of 2025 yet because it's delayed. This marker is going to continue to drop. The market is a lot more difficult. Pricing continues to move downward. So when we look at these charts here with this index of 153.81, the last time we saw something like this was back in essentially 2017. Right? In 2017, we were at 155 at Q2 of 2017. So this really shows you what is going on here in the marketplace here across Canada and Vancouver as a whole. That is why it is so important when you're looking at real estate, you're not just focusing on broad real estate specific stats, but you're looking at things on a more economic, a more advanced level. Because when you understand inflation, what inflation does to all of our wallets, what it does to our assets, to our net worth, this is quite problematic. And when we look at these charts, that's why it is really important, especially if you're looking to get into the market or you're looking to sell, how is your asset performing? You know, as a buyer, when you're seeing something like this is great. This, like I said, when we get the Q2 insights here, it's going to continue to drop. This is something that you're looking at in terms of a buyer, because you're essentially being able to run back the clock and purchase something back 8 years ago at 2017 levels. As a seller, this is a hard thing to look at. And if you're someone who's holding property, but again, you want to have more of an outlook in terms of what is going on with the history of this pricing. And because we have data that goes back to 1970, you can see that even with this drop in pricing, we're still near all-time highs in terms of price point. So we want to look back at where were some of these other oddities in the market that showed us perhaps a launch point of what to expect moving forward. We all know that in the 1990s, that was the last big catering in terms of the property value because of what happened with the market resetting. And there wasn't really any big drops. It was quite flatlined here for several years, essentially from 1988 all the way until 2001. So it's about 13 years. There wasn't any real growth. And in fact, it was a little bit more downward pressure. And then we really started to see this wave start in 2001. And it continued to crest it until 2022. Some of these other dips here, you can see that this is the financial crisis in 2008, where this dropped a little bit, but then it rebounded and continued to move forward. But you know, we haven't seen something like this in quite some time. But when we look back at 2022 with everything that's been going on, we have so many world events going through at such a high level. We came through COVID. We've had the highest interest rates we've seen in 20 years. We have now an Iranian and Israeli war that could spill out, that's going to hamper oil pricing. We have the tariffs with the Americans and what Donald Trump is doing. So there's so much instability in the marketplace that this really shows what the reasoning is for this. Plus, in 2022, we printed so much money for so much help coming out of COVID that we knew that inflation was going to be a thorn in our side. And this is exactly what happens when you have countries that just start printing money and they are not looking at the bottom line in terms of protecting themselves in the here and now. And you have politicians just wanting to cover their voting base in the present and not looking to the future. This is some of the consequences that can happen. So how far is this going to continue to drop? We know that we still have 2 quarters in 2025 to look at where this is likely going to drop here. But where's it going to flatline? For myself, and I think a lot of other people in the real estate space, I think this market's going to stay soft like this from 12 to 18, maybe 24 months. We're about 3 to 4 quarter point rate drops from the Bank of Canada to see some real impact in terms of activity in the marketplace. Now there's only, possibly one price reduction from the Bank of Canada, maybe in September, but for us to get to that place where we're going to see 3 or 4 rate drops to really turn buyer behavior in a different way, it's likely not going to be until a year from now, maybe longer. And then even with that, you're going to have buyers absorb a lot of this inventory that we're seeing, and then that's going to somewhat do some changes in these price points here as well. We also need the government and a lot of these global crises to be able to resolve themselves, because if we continue to print money and hand money out like there's no regulations to that, it's going to affect our inflationary numbers as well, which is not good. So we definitely are in a very sensitive market. I've never been in a market like this, and we can even see with the history of the graph, we've never seen a sharp drop off. But when we look at what's been going on over the last couple years, it explains exactly why we are suffering in terms of inflation, in terms of overall property pricing. So is this all doom and gloom? I think there's opportunities everywhere, no matter where you're at. If you are a buyer wanting to get into the market, this is a fantastic time to do it. Like I said, it's still going to be soft for quite some time. People are getting really good value purchases now. And at the end of the day, if you have long-term hopes in holding, it's not going to be an issue for you. If you're looking to be in a home for 10 plus years, you're going to be able to get out of this chart. And at some point, pricing will go up because, as I've outlined in previous videos, we are going to be in a shortfall in terms of supply just because of the amount of construction that is starting to lag, housing starts and things of that nature. So, and even in situations like this, life sometimes cannot take a pause. People get divorced, there's a death in the family, kids move out of the house, your family expands, and despite the market that you're in, people are always going to have to buy and sell. You can't let a lot of this fear influence your decision making. That's why you partner with a realtor, but you have to look at this data and see if it does make sense for you. And like I said, if you want some more insights on this, you can book a discovery call with me. All my information is in the description below to help you go through some of these charts, because it is going to be a little bit of a long haul here in the marketplace as a whole. But I did want to share some of this data with you so you can see exactly what's going on with your asset. And until the next one, I'll see you later.